Hi, welcome to Market in a Minute. Did you see the Duke UConn game on Sunday? That three-pointer right at the end of the game with UConn to win the game? I didn't believe it. I was going crazy. I didn't realize how much I didn't like Duke. um, Powell on Monday, he said that inflation expectations are well anchored. Okay, with the spike in oil, they're not seeing any change in the expectations for inflation over the long term. I think that's really important. I think we're seeing signs of a bottom occur here. So if you can anchor inflation for the long term, you're going to provide a bottoming process for the overall markets. So let's step back a little bit. Okay, my career, 40 years now as a money manager, when I went to the Berger funds, this is a long time ago. First day on the job, Bill Berger comes into my office. This guy he looked like Santa Claus on steroids, very tall man, white beard. He says to me, Pat, buy tennis balls, not eggs. Okay, at the time, it was a little bit insulting, but it stuck with me over time. Now, what we want to do in this environment, we want to buy tennis balls, things that'll bounce, and bounce in a big way. Eggs just, when they go down, they just stay down. So we want to buy those tennis balls. So we have a nice list of tennis balls to buy, things that could rally 20, 30% as we go through the year. Disclosures, please read those at your convenience. Market update. So where are we with all this? The S&P, the NASDAQ, the Russell 2000, they're all more or less in that correction mode, down close to 10% or more. The Iran conflict we thought would hit the markets by 5%. So there's more going on to the markets than just the Iran conflict. The bond market hasn't helped out at all. Usually in these sort of crises, you'll see the bond market act defensively. It did not at all. So just to refresh your memory, our outlook starting at the early, our outlook starting at the beginning of the year was the markets were going to correct and be somewhat similar to 2025 when they fell as much as 20%. So looking at the internals of the S&P 500, 42% of the stocks are now down over 20%. So we're seeing an internal bear market in the overall stock market itself. Just coincidentally, on April 8th of last year, the market bottomed out. So I'm not saying the market's going to bottom out at the same time, but things are kind of lining up. Perhaps it will. The charts between the 2 years look very similar. So we still have the S&P 500 stuck with 47% in technology, so that's a long-term problem, and the market's starting to correct that issue. The markets are big time oversold. Anything positive coming out of the Middle East, we're going to see a big bounce in the overall markets. So the fact that Powell on Monday said that basically the oil supply shock is not going to cause long-term inflation, I think that gives the markets some resolve here to start thinking about more than just what's right in front of their nose. Maybe that's what's out in 6 months. So likely what will happen over time is that interest rates will peak, come back down, interest rates cuts will occur. We'll start to look out to 2027, very positive price scenario looking out to 2027. So we put on the chart here, this is the S&P 500, 6250. Why do we have that on there? We're not too far away from that currently. We're less than 2% from 6250. Well, down here, the blue line's the S&P 500, the black line's the earnings. So here's the earnings over here on the right, and the S&P 500 over here on the left. So when these two cross or get near to each other, it means that we've taken out the excess risk, the hype in the overall markets. We've taken that out of the markets. So when the trend of the market is basically at or in line with the overall earnings in terms of both of their appreciation, you kind of wrung the market out. So 6250 might be the area where the market bottoms out, or maybe it happens before that. Iran, okay? I can't believe that they're still firing missiles off after hitting 10,000 different targets. um, we're still having the problem of their ability to shoot off missiles. We think they're coming to an end of that. So we'll see. It was interesting on Friday when Trump announced that 10-day extension. Um, the markets capitulated, in our opinion. A little bit of a mini capitulation occurred in the oil markets. Friday was ugly. I mean, really ugly. So we think we're in a extremely oversold condition in the overall markets, that the sentiments turn really negative, looking for higher inflation, higher interest rates, slower economic growth, and a potential recession. It's gotten really negative. So we might have another knee-jerk reaction to the downside if boots on the ground actually occurs. So if we put our troops into Iran, I think it might be necessary. We might see another hit down on the overall markets, but it resolves the issue. So the markets will at some point start to look through all this, and it'll really start to do it if the 10-year Treasury starts to come back down in yield. So here's the 10-year Treasury. Here's 4.5 here. It was earlier in March, it was at 4, under 4 actually. It broke through the 200-day moving average. It shot up to that close to that 4.5 level at 445. It's now back down approaching 430. We think if it breaks down below the 200-day moving average at 420, it's the market's going to like that a lot, and we've likely hit the bottom in the overall stock market. So buying tennis balls and not eggs. So we want to focus on high quality companies that have good long-term growth, attractive valuations, rising near-term earnings, have good management teams, good balance sheets. So things that have a moat around them, that they can protect their business. So these are our favorites. Happen to be Amazon, Google, Uber, Capital One, Carnival Cruise Lines looks really attractive. That's a good little company. We haven't owned it in a long time. It's pulled back in a big way based on the oil prices going up. Visa, Lilly, Netflix. So we have about 40 companies that we think have 20 to 50% upside potential. So we put them in these buckets. And the higher the quality the company is, with the higher upside potential, the more we want to own those companies. So we're getting a lot of really good potential stocks to buy. We started buying some of them now. What else, right? So the BDCs look attractive. They've come down in a big way. If interest rates come back down, that'll kind of cure the fear about the economy falling apart and their loans being having to be guided downward. So a lot of the BDCs look interesting. So we like BXSL, Blackstone. We like the BDC. Yields over 10%, high quality, very high quality portfolio. Yields way over 10% in terms of dividend yield. Another one, OTF. Okay, it's a little bit more aggressive, more upside potential. Yields above 12. So OTF, BXSL. The mortgage REITs look great. I mean, they've come down because of the pop in the 10-year Treasury with bond yields going up. They own agency bonds. And our favorite there is Dynex, DX. Yields 16%. Really good management team. The equity REITs actually look attractive. And for that, we just want to own an ETF, IYRI, yields over 10%. Individual stocks, okay, Best Buy. We haven't owned this forever. Okay, we think it's starting to look attractive. 10 times earnings, over 6% dividend yield. Think of it as somewhat similar to Home Depot. They dominate the area that they're in. There is some ancillary competition outside of the traditional retailing, but they dominate the area. And when Home Depot's comps pick up, the stock does really well. When lumber prices pick up, Home Depot does really well because their comps go up. Now with Best Buy, we're getting I was just in the stores looking around. We're getting computer prices that are higher. And actually, they had some AI computers there too. But computer prices are going up because memory prices are going up. So we'll probably have a couple years of high memory prices in front of us. So Best Buy should do fairly well in the short term. And I really like it kind of in that intermediate term as well. We think that the PE multiple could go to 13, 14 times, plus picking up a 6% dividend yield. The defensive stocks have been horrible, right? So gold, gold's down from 5,500 an ounce, it's down almost 20%, almost a bear market in gold. Think of gold like oil. Okay, it takes about $1,200 to get gold out of the ground into the market. $1,200 an ounce. Now at $5,000 an ounce, you're way far away from the bottom where gold could actually go to. In bad times, commodities go to maybe even less than what it costs them to get it out of the ground to market. So oil at $100 a barrel. In Saudi Arabia, it costs about $8 or less to get oil out of the ground. They basically just put a straw in the ground and out comes oil. So really cheap. In some of the U.S. Oil companies, they're in the 20s to get oil out of the ground to the markets, maybe 30 or 40, but somewhere in that range. It's in the high 20s is what their cost is to get that incremental barrel out of the ground. Some of the more marginal guys are at 60. So oil at 100, could oil go back to 60? Absolutely. These are not defensive assets. Just keep that in mind. If you want to be defensive, you got to buy the tennis balls. Okay, buy things that actually have earnings growth that are attractively valued. So we want to actually start buying some of these names now. We're defensively positioned. We want to get ready for the next rally, and a lot of these stocks are really attractively valued. So we have 40 stocks currently that we like a lot, that have that 20 to 50% type of returns over the next 6 months. As you look out to 2027, we have so many stocks that look attractive based on 2027 earnings. So we think we can get a 20 to 30% type of returns in some of these names over the next 6 months as they come back into favor, as they bounce, and then they start to look out to 2027. So come to my work website, PVG Asset Management. Check out some of the strategies we have. We have some really good growth strategies that are tactical. And then our emerging healthcare, it's been beat up really hard in this overall market. I think it's a really timely purchase as well. So we have some really good strategies and then our income strategy as well. Our income strategy has done really well. Income conservative, they've held up really well. Our loss averse equity income really has been a really good performer in certain markets like this. So if you have any questions, come to my website, Patrick Adams CFA, ping me. Also, sign up for a hard copy of Market in a Minute. Take care.